As always, appreciate you, Coach Matt. And what that's going to do is going to take us into our last segment of the day here on our Thursday. It's our Coach's Corner segment where we have, different things we do depending on which day of the week it is on the halftime report. On Tuesdays, we do the Queen's Court. On Wednesdays, we do Jedi Options. And on Thursdays, we've been playing Buy One, Hold One, and Dump One. We bring Coach Greg in here. He brings three fundamentally sound companies that he's interested in. He lays out them on the charts. He kind of talks about them a little bit. Then we have a discussion about which one we would buy, which one we would dump, and which one we would hold. Greg, what you got for us today?
Well, if we look at XLU there, which we did in our little sector talk there, it's held up really, really well. I know this isn't your go-to trading sector, but this has been pretty impressive recently. It's still high basing, even with the last couple of days in the markets that were not pretty. This thing's still holding strong. The other reason I picked the utility sector today is August and September, seasonally speaking, are usually pretty good for utilities. If you look at our newsletter on the weekends there, you'll see that we break down the hottest and the nottest of the sectors, and XLU is I think it's number 2 for the months of August and September. So I thought it was a good spot to go. So I picked 3 in the utility sector. Again, like I said, I'm not expecting this to be, you're not going to be trading this super directionally, but it's got some interesting companies in it. So today I picked Dominion Energy, Consolidated Edison, and PEG, which is public something or other. I forget what that one's all about. But let's start with Dominion first. If we look at that chart there, again, not a rock star. You're looking very neutral here. However, we're looking at, like a mini breakout here, holding up pretty well though. Like I said, overall, you're not going to see any of these crazy utility stocks just going to the moon. It just doesn't happen that way. But you've got a head and shoulders pattern here, a little breakout today. You get a little bit of price appreciation out of this, but this is more along the lines of old money homes where you're going to be looking for dividends and things like that. Long term, as Tyler just put up here, very, very neutral over the last 3 years, but you can also see we got lots of dividend payments too. So numbers wise with this one, I added a little something today. We've been throwing cover call, returns on there, and added analyst recommendations on today, just to add a little something to this. So I'll roll through that. Price wise, we're about $78 stock. Dividend yield is 3.23%. 0 years of consecutive dividend increases. They reduced their dividend last year. They started dividends in 1925. Their payout ratio currently is 102%. So something to take note of. PE ratio is about 28. Look at the assets versus liabilities. We got 96 billion versus 70 billion, which is solid. Free cash flow is negative 1.4 billion. What you're going to find with these utility stocks is they don't hold a lot of cash on hand. 0 years of consecutive net income increases. They do not have weekly options. Their approximately 30-day cover call will get you about 1%. Now, analyst ratings, if you look at those, a 1 is a strong buy, a 3 is considered a hold, and a 5 is a sell. This one's running at about 2.2, so it would be in the buy to, between the hold and the buy range for the analysts for Dominion Energy here. So that's the first one up on the docket. Next one is ED. Consolidated Edison. So this thing's been around forever and a day. Again, very similar chart, somewhat neutral, looking for, was looking at a breakout, a week ago or whatever there, failed a little bit there, but still holding up, reasonably well. Chart wise, I don't like this one quite as much as Dominion, but again, very similar patterns. This is what you're going to see with utilities. This is what you get. So, overall numbers, looking at the numbers here, ED $76 stock, so comparable to Dominion, 4.05% dividend, 46 years of consecutive dividend increases. Started paying dividends in 1885, so like I said, they've been around forever. Payout ratio is 94%. PE ratio of 23. We're looking at assets 63 versus 43 for assets versus liabilities. Again, negative 1.72 in free cash flow. So again, not one of these companies that holds on to cash. And then we got zero years of net income increases. It does have weekly options, and their 30-day cover call is approximately 1.75%. Now, for their analyst recommendations, they are a 3.5. So they are between a hold and a sell on the sliding scale there. Growth numbers I forgot for Dominion were 5.9 and 11.8. So they're expecting more growth next year. Edison, however, 5.8 this year and expecting 3.5 next year. So a bit of a decline for Consolidated Edison there. The last one we're going to look at is PEG, P-E-G. Public Service Enterprise Group. So this one looks a little bit better chart perspective, little high base here, not as expensive of a stock. If we take a look at the weekly for that one, Ty, you see that you've got a little bit of a growth component to it. Not, again, I don't like to even use those words when we talk about utilities, but it's got a little bit of more of an upward swing for this one here. Numbers wise, we're looking at $64 stock, so 3.19% dividend yield, 9 years of consecutive dividend increases, paying dividends since 1907, so been around a long time. Payout ratio is a paltry 68%. PE ratio, the lowest of the bunch at 22. Sales growth numbers, they're getting 6.6 this year, but they're expecting a decline of 0.7% next year. So that's very interesting to note. Assets, liabilities, 50 billion versus 34. They are negative 420 million from a free cash flow perspective. Their net income is 4 years of consecutive increases. They do not have weekly options, and their ROI is about 1.5%. And again, they came in the same as Dominion at a 2.2 on the analyst recommendation. So that's between a hold and a buy for that sliding scale. So just 3 utility companies. Like I said, they're not going to blow your socks off from a growth perspective, but they do have some other qualities that I look for in companies.
Mm-hmm. Appreciate you laying them out. Utilities here, obviously utilities have been hot recently. So we've got 3 names that we're going to analyze. There's a couple of names that you didn't bring up that are in utilities that I actually would have been like, I'll buy that one, but that's not the game we're playing here, Greg. So what we're going to do is we're going to look at all 3 of these, the way that we play this. Now, Tyler, you're going to kind of capture all this data. You've got it on a spreadsheet, lay it out for us again, and then we're going to start making some choices here.
Yeah, sure. So you got them lined up here: Dominion first, then Con Edison, then your PEG. I'll point out the things I like about each one of these columns, and then Tim, if you want, I'll go first. Price range all pretty much the same. PEG is the cheapest, albeit not by much. Con Edison's got the highest dividend yield, but they're all pretty beefy. The thing to compare is what do you get in the bank, and what is the S&P 500 paying? You get jack in the bank. S&P 500 dividend yield, I think, is like 1.3 right now. So these are definitely much higher dividends than what you're getting in the broader market. Con Edison's the old grandpa of the bunch. Been around since dividends started in 1885. The most dividend increases. Dominion, the only one that cut last year. Payout ratios, highest for Dominion, lowest for PEG. PE ratio, lowest for PEG and highest for Dominion. Growth rates look similar. This one is interesting per Greg's point. Assets versus liabilities all look pretty similar to me as well from a percentage or ratio perspective. Free cash flow, Con Edison's got the least. This is 1.72 billion. PEG's got the not the least bad, not the most.
The most of the least.
The least negative number. Better off, I guess. 4 years of increasing income with PEG, which is interesting given what happened last year. Weekly options, only one that's got weekly options is Con Edison. It's also got the best potential ROI, at least if this last month was indicative of a typical month. And it's got the best rating. So,
and you wanted to go first, right?
Yeah, I'll go first. I think this one was kind of easy for me. Dominion Resources. So dividend yield, payout ratio the highest, PE ratio the highest, no weekly options. The only reason I would have bought Dominion is if the chart was best, and the chart was not best. It put me to sleep. So I'm certainly not buying that one. The one I liked best was PEG for multiple reasons. The chart was best, no doubt about it. You actually have some growth there. I like that trajectory, number one. Number two, the stock price is the cheapest. I think that helps. Number three, the payout ratio is the lowest, and the dividend was still decent. I know it's the lowest, but not by much. So they could increase the dividend if they wanted to. And they got more free cash flow. I don't really care about that, but it is noteworthy, I guess. Increasing income's nice, probably why their chart looks better than the other two. So PEG going to be my buy for sure. B is for buy. Con Edison's been around forever. I'm going to take that as the hold. All else equal, I'd rather hold that one than Dominion. The charts were kind of sixes for me, but I like the covered call potential in Con Edison, and I just like the history and its stability a little more than Dominion.
Mm-hmm.
So I'm selling Dominion.
Matt, what do you got here?
I don't know. I kind of feel fundamentally these are all sixes, honestly. Like when I look at their P ratios, forward P ratios, PEG ratios, price to book, like every fundamental metric, I got some good, some bad, but honestly, I'd rank them all fairly similar fundamentally. I do think Tyler's right on PEG being the best technical situation. I do think Dominion has an interesting technical pattern though. Like Con Ed just like write some cover calls, don't even care about it.
Mm-hmm.
But when you're looking at Deer doesn't.
You know, my fingers are, I'm such a creature of habit. It won't let me put in D.
You're like DE.
It automatically goes to E.
I want to look at Deer. I do think there's an interesting technical formation and a high base here on Dominion that you could say I'm comfortable with triggering on, but we're talking utility stocks. It would have been easy if he would have added Southern or Duke for me.
Mm-hmm.
That would have been a lot easier. I like both Southern's weekly chart and fundamentals and Duke's daily chart and fundamentals a little bit better than these three. But this is the game we choose, right? We got to pick buy, hold, and dump on these three. I'm trying to buy time because I don't want to buy any of them. But since I have to, I will go ahead and go with the buy on PEG, a hold on Con Ed, and a dump on Dominion.
Okay, Mark.
Listen, all things being equal, give me the stronger chart, and I think things are pretty equal here. So I'm definitely a buy on what was it, PEG.
Mm-hmm.
And the other two, like I mean that's just how I go. Like are the dividends equal? Are the fundamentals equal? I do like the free cash flow on. That's a big metric for me. It's why I got so involved with Gilead Sciences. Free cash flow is a big deal for me.
Mm-hmm.
And so but relatively, if they're all equal, give me the stronger chart. I think PEG has the stronger chart because while I usually play these areas for cash flow, I don't mind a little price appreciation, right?
Yeah.
PEG seems the best set up. Boy, I'm just splitting sixes on the other two, what I'll buy and hold. All things equal, give me the hold because the biggest dividend share, I think that was Edison, if I remember right. So all things being equal, give me the bigger dividend yield as the hold, and then just quibbling, selling the other one because.
So it sounds like we've had chalk for Tyler, Mark, and Matt. I'll be different. I agree with the sell, and I agree that the strongest chart is obviously that last one that we had. But I like the return on the cover call, 30-day cover call. I mean, for me personally, when I'm approaching, and I like the fact that there are weekly options. If I'm going to buy a utility, I'm going to write cover calls on the thing every single month, most likely, and I'm going to want to pick up some cash flow. So if I'm going to pick up a utility here, it is probably a Southern. It's not on this, but playing the game here, I will buy the weekly option 1.75% cover call. I will hold PEG, and I will dump Dominion. Greg, now you get to tell us what you liked about what we saw, what we didn't. This is your favorite part of this game, by the way. So what should we have picked up on that we did not, if anything, Greg?
I think you guys all have great points, right? For me, this comes down to a question of what you're looking for. And if I'm looking for something, and I know that it's a neutral type chart, and I know that I've got a longer term focus here, then I want the most money. And I think for me, that's where Edison comes in. They've been paying dividends forever and a day. They're increasing their dividend every year for 46 years. We've been through a ton of financial stuff in 46 years, and they just said, F it, we're going further, and so 4.4% dividend, love that, right? They still have a growth component, like their sales growth is still decent. Free cash flow, that's just the way utilities are, so that doesn't bother me at all. I love the fact that they got weekly options, and I look at this and I go, 1.75%. If I could even sell that 8 or 9, 10 times a year and get 1.7%, and then you add that 4% on a neutral stock where I don't have to worry about the big up and down price swings, I'm going to make a boatload. And the chances of them, changing that after 46 years, I think are very low. So for me, I'm buying that one as well. Now, if I look at the other two, a couple of things I don't like about Dominion. Their payout ratio is too high. They just cut their dividend last year already. So are they going to cut it again because their ratio is high? That's potential. So that makes me shy away from there. Their covered call is the lowest. I threw this analyst recommendations in here as a red herring because I don't give a rat's ass what they have to say, to be honest with you. But some people do.
You didn't hear one of us mention it. So
I know, but
none of us cared.
But some people do.
None of us cared.
Some people do, right? So that's why I threw it
Only
in there.
people that don't know how to read a chart.
Exactly. But anyway, so I don't really care what they have to say. So for me, Dominion's out for those reasons of cutting their dividend. That leaves PEG ratio. I do like the chart. The only thing that bothers me a little bit about this is the projection for sales growth next year. That negative kind of bothers me a little bit, but they've had 4 years of consecutive dividend or net income increases, which I do like. Their covered call is comparable. I would prefer weekly options. I did notice, I believe on that one, I did see something. I think maybe next year they're going to get weekly options. If I remember the chart right, there's or the option chain. There's a thing in next January or something where they may have weekly options. So if they got that would be a little bit better. So that would be the one I hold. And then like I said, for those reasons that I mentioned, I'm getting rid of Dominion. So
gotcha.
Good points by everybody, and I think the breakdown's pretty easy.
So you mirrored me. I appreciate that, Greg.